on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000.
According to Warren Buffett, investing in an index fund was the best decision he made. Think of it as a big basket of goods and you get a piece of everything. For instance, you want to walk into an ice cream store selling 10 different flavors each for $5 a scoop, and you don't know which one is best. So, instead of buying one scoop each, the shop offers you a sample box of ice cream containing small portions of all 10 flavors. This way, you can have a taste of all flavors without spending on one scoop each. Same applied to stocks. You can visit a stock store, and instead of buying each stock individually, you can invest in an index fund and get a portion of everything you can ever imagine. According to Buffett, by periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. The thing is that only 24% of all active funds beat their average rival fund in the decade, ending June 2022. The best thing about index funds is that you don't need to read any earning reports or research stocks for investing in an index fund. Just consistently buy the stocks, and that's about it. With index funds, you have an easy sample platter of everything that you can imagine. You get the SP 500 index fund, the total stock market index fund, the real estate index fund, the bond index fund, the mid-cap index fund, the small-cap index fund, the large-cap index fund, and the list can go on and on. However, there are generally 4 common types of common index funds that you can invest in. The first type is associated with company size. You can either invest in large company funds, mid or small company funds. Second is index funds that capitalize on locations like US, emerging, and foreign funds. The third type deals with business types. For instance, industrial, tech, real estate, etc. The fourth type is tracking currencies, bonds, and treasures. Simply put, there is always an index fund for you to invest in. To make it easier for you, we have the top 5 index funds that can make you rich. Although it may seem like a pretty simple concept, some index funds are not equal and might make more money than others. So it's important to understand how to invest in index funds and what are their benefits. On the 5th number, we have an all-time favorite and classic, VFIAX.
But as long as I wasn't putting all my money in at one time, if I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period,
This is an index fund that tracks SP 500, the top 500 publicly traded companies in the US. By investing in VFIAX, you are getting a chunk of all the top 500 of these companies. It's like buying the best wigs from Apple, Google, Amazon, and Microsoft. VFIAX invests in the 500 largest publicly traded US companies, representing a wide range of industries. This diversification helps reduce the risk associated with investing in individual stocks, as losses in some companies can be offset by gains in others. Like Buffett said, one thing that you should keep in mind when investing in an index fund is the cost. VFIAX has one of the lowest expense ratios in the industry, which means more of the investors' returns stay in their pocket rather than being paid out as fees. VFIAX also follows a passive investment strategy, meaning it aims to replicate the performance of the S&P 500 index rather than actively picking and choosing individual stocks. Passive management typically results in lower turnover and associated costs. According to Buffett, a low-index fund is the most sensible equity investment for the great majority of investors. Over the long term, VFIAX has historically delivered competitive returns compared to many actively managed funds. VFIAX requires a minimum initial investment, which is subject to change over time. Check the current minimum investment required on the Vanguard website. Before investing, conduct thorough research on the fund's historical performance, expense ratio, investment strategy, and risk profile. Consider how well VFIAX aligns with your financial goals and risk tolerance. Index funds like VFIAX are best suited for long-term investors. Avoid frequently trading and allow your investment to grow steadily over time, benefiting from compounding returns.
Is there a point where index funds theoretically can't work? Of course. If everybody bought nothing but index funds, so the whole world wouldn't work as people expect. There's also the problem, one of the reasons you buy a big index, like the S&P.
Thinking about covering the entire US market in one fund? Then this one is for you. You could think of anything from large cap, mid cap, and small cap to any industry, and VT-SAX will probably cover it. This is the most unique thing about it, and it could be the only index fund you need to invest in your entire lifespan. While Buffett and Charlie Munger believe in the power of the S&P 500, there is always a chance that it might not do better than any other index fund. So what's the smart option? Just invest in everything and hope that the market is going to grow and expand over time. VT-SAX covers more than 3,500 stocks. So even if those 500 companies don't do well, you still have another 3,000 companies to rely on. Warren Buffett once said, "The goal of the non-professional should not be to pick winners. Neither he nor his helpers can do that, but should rather be to own a cross-section of businesses that in the aggregate are bound to do well." However, there is a minor but obvious downside to investing in VT-SAX. There is a minimum of $3,000. And if you want to avoid that, you have to buy an ETF version of the same fund, the VTI. There is also a difference in the expense ratio of both a 0.04% ratio for VT-SAX and a 0.3% ratio for VTI, which is still so much better than so many index funds out there.
Today, for a 10-year purchase of a 10-year bond at whatever it is, or 10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Well, that brings us to a question that a viewer wrote in. This is T67. Piyush Pant says, from the annual report in the 13F, it looks like Berkshire will...
As Warren said, he'd buy SP 500 in a second. It is undoubtedly one of the most efficient ways to get rich by investing in index funds. Similar to the aforementioned VFIAX index fund, it covers all 500 top publicly traded companies in the US. However, there are some minor differences between the VFIAX and the SP 500. For starters, with the SP 500, there is zero minimum, so you don't have to pay a $3,000 fee. Then, there you go, it's free. Apart from this, it has a 0.02% management fee, which is half of Vanguard. Like Warren said here, SP 500 is how you can use dividends to get rich. You can't beat the SP 500. According to him, for most people, the best thing to do is to own the SP 500 index fund. People will try and sell you other things because there's more money in it for them if they do. Both amateur investors and experienced fund managers have found it difficult to outperform the S&P 500, a well-known benchmark for the US stock market. The efficient market hypothesis, which contends that stock prices already take into account all relevant information, is the source of this problem, making it difficult to identify persistently mispriced stocks and forecast market moves. The inherent diversification advantage of the S&P 500 nevertheless poses a challenge because concentrated portfolios run the risk of heightened vulnerability if individual stocks underperform. Potential returns are further reduced by transaction costs and fees related to active management or frequent trading. Even while individual investors or funds occasionally outperform the S&P 500, maintaining this performance is very difficult because of the continuously shifting market conditions, economic considerations, and corporate performance. To get market returns while minimizing costs and emotional biases, many advocate for a passive investment strategy, favoring low-cost index funds that track the S&P 500. Emotionally driven decisions and the uncertainty of predicting future market moves further compound the issue.
Well, was after all a mere boy of 89. thinks that Berkshire can do a little better than the S&P. From this point.
According to Charlie Munger, if you are trying to beat the SP 500, you are in denial. And hands down, it is the future of index funds and one of the most efficient ways you can get rich. While buying SP 500, you are buying America. It might sound crazy, but it is true.
Think you're king of the world. You could fondle it, you could polish it, you could do all these things with it, stare at it, but it isn't going to do anything. Now, it's all you are doing when you buy that is that you're hoping that somebody else.
Warren Buffett has frequently voiced his support for inexpensive index funds, especially those that follow broad market indices like the S&P 500. The foundation of Warren Buffett's investment strategy is simplicity, patience, and a long-term outlook. He frequently recommends to individual investors to stay away from high-cost funds, frequent trading, and market timing. Instead, he recommends a buy-and-hold approach using inexpensive index funds that offer wide market exposure. According to Buffett, a lot of very smart people set out to do better than average in securities markets. Call them active investors. Their opposites, passive investors, will by definition do about average. In aggregate, their positions will more or less approximate those of an index fund. Therefore, the balance of the universe, the active investors, must do about average as well. However, these investors will incur far greater costs. So, on balance, their aggregate results after these costs will be worse than those of the passive investors. The low expense ratio of the Vanguard 500 Index Fund Admiral shares, or the FXIAX, is in line with Buffett's emphasis on minimizing investment costs. FXIAX gives investors access to a diverse portfolio of some of the biggest and most reputable U.S. firms by tracking the performance of the S&P 500 index. Many investors now view low-cost index funds as a core component of their portfolio as a result of Buffett's financial success and his support for passive index investing. Even while it's important to keep in mind that Buffett's opinions are not recommendations for particular investors, his ideas about simplicity, diversification, and long-term thinking can be applied when assessing investment choices like FXIAX or other comparable index funds. Investors should always do extensive research, evaluate their financial objectives and risk tolerance, and consult a professional before making any decisions.
You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. And I would like to just spend just a couple of minutes giving you a little perspective.
Like Buffett said here, there are only two ways to fail. However, what if you find an index fund that's free market index? Warren Buffett once said, there are a few investment managers, of course, who are very good, though in the short run, it's difficult to determine whether a great record is due to luck or talent. Most advisors, however, are far better at generating high fees than they are at generating high returns. In truth, their core competence is salesmanship. Now, taking everything into account, our top choice for index funds is Fidelity, a totally free market index like FCROX. Just like VT Sachs, Fidelity covers pretty much everything but a few dissimilarities. While VT Sachs has a minimum fee of $3,000, FZROX has a zero management fee. This is the reason why it is number 1 and not number 4. And guess what? It has a zero expense ratio as well, which means that it will be entirely free. You heard that right. This is what totally changed the way things worked in the index fund industry, because Fidelity was the first index fund to come out as an entirely free index fund. However, companies like Vanguard won't still come chasing after zero expense approach. Why? Because companies like Vanguard have brand recognition and investor royalty behind them. While we love Vanguard, that expense ratio is going to add up when you make more and more money. On the other hand, Fidelity lowered their expense ratio, making people buy in, and it's going to save you a lot. Just think about it. It will save you $400 a year per $1 million that you have invested, and that can potentially be worth $21,000 in a few years invested, an 8% return.